Hey, how's everyone doing today? Welcome back, and today we're going to talk about taxes, how to get started in finding a way for you to save money on your taxes. And there's a couple of things that we want to take a look into before we get started, right? Obviously, all of us have to pay taxes, and it's something that it's a necessity. I do have some friends that always say that it's good to pay taxes than not to pay taxes, right? Because obviously you you want to stay out of the IRS eyesight, right? You want to stay out of their way. So it's always good to report something, right? Now, I do a lot with business owners, correct? And sometimes when you're starting a business, it's not easy, and you might not have any profits for that year. There's businesses that report losses. So if you put, for example, if you had a job for 10 years and you're able to save up $50,000, $100,000, and you decide to go into business on your own, and when you go into business, most of that money from your savings is being used as capital to start your business, then that's a loss. You can't report any income for that year because you put capital into the business to get it started. Also, for instance, if you're using your credit cards to pay your mortgage or your rent, utilities, then that's obviously a good sign that your business is not making money, and you need to adjust that. So when it comes down to paying taxes, it really is whether you had a profit that year or you didn't have a profit, okay? And if you didn't, then that's fine. But if you did have a profit, then how do you go about making sure that some of that money is kept in your pocket? Another thing that I hear a lot is that the money that you put into your taxes goes into your Social Security, right, for when you retire. And one of the things that I like to always point out is that your Social Security is just a safety net in case you didn't save any money. But if you're savvy with your money and you know where to allocate that money, then there will be no need for Social Security. You will have enough money saved in your own retirement plan for you to be able to continue your lifestyle when you retire. Okay, so that's worst case scenario, is having to use your Social Security. And if you're able to manage your money a little bit better than the government does, and who doesn't, right? Me, for instance, I know I can do a lot better with spending my own money and trying to figure out how to get the best return on it than the government will. So for instance, if I'm getting $1,000 or $2,000 every month from the government since I'm from 71 till I'm 90 or 95, so that's $20,000. Say I have $300,000, $500,000, something like that. Then I need to adjust my retirement so it matches that plan. Okay, but first off, we want to make some money this year. And we want to figure out how to keep it. So first, we want to see how much money we made last year, right? So whatever we made last year, say 100,000, right? And we had to pay $30,000 in taxes, right? About 30%. I think the tax rate went down this year, so now it might be like 20,000. So that's a gimme, right? And then how much was it last year? And figure out what plans do you have, right? So if you're running a business and you have no intention of doing anything, then most people write off all their expenses as much as they can, right? Which is great to reduce your tax liability, but at the same time, when you're trying to grow and expand your business, it doesn't do much for you because it shows that you didn't make any money. So you want to make some money so you're able to expand the business in a way that makes sense. I have a lot of people that want to buy a business, and I have several listings now. Where we always get stuck is trying to prove the income, and mostly is with taxes, right? Because a business owner will deduct all their expenses, and a business buyer will not take somebody's word for it. They want to see what you reported on your taxes and make sure that that's verified. So if you have money to pay for your taxes, then you're obviously doing pretty good. Another thing is that always comes to my mind is that there is no need for this, because every time you go and buy something at the store, you're paying taxes right there. So there's a standard deduction in taxes, that's what it's called, that depending on how many people it is, they give you like $10,000 back. I like to look at it, and I would have to look more into it, but those $10,000 that you're getting back from that is because you already paid that money in your receipts when you go to the store. So you're getting a credit for whatever you had spent from the whole year. Okay? So what plans do I have? Do I want to sell the business? Do I want to get a loan for next year? Do I want to buy a house? Do I want to make some investments? What do I want to do? Right? Do I just want to save as much money as I can? Right? Do I want to grow the business? You have to think about this and then go from there. Right? So if I pay $30,000 and then this year the tax rate is lower, I might pay $20,000. If I don't want to pay the $20,000, what do I have to do for me to be able to be able to report everything in a way that shows a profit but doesn't affect me in a negative way, right? So there's credits available for you. And these credits range from different things. I see them as a perfect opportunity. Say, I know not everyone could change their industry from one industry to another because there's credits, but there are people that actually will open up a business just for the credits that are available. I, for instance, do real estate. So with real estate, if you have some money, say you have $50,000, I would put it into a real estate purchase, maybe an investment, and start getting credits from that investment in that fashion. So maybe not this year, but say you got with me on January or with your tax guy, then by the end of the year, then you have a lot more credits available. So if you had come to me last year and you say you paid $30,000, if you know you're going to pay $30,000 this year, what can you use those $30,000 for, so that the following year, right, that tax liability goes down? And I would have told you, hey, spend the $30,000 into one of these new industries, into a home, an investment house, maybe a investment group, or into a business where you could get some of these deductions that will help your tax bill, right? So that's one of the things I would have done. Also, there is other ways to do this that are offered for you as a small business. There's what I like to say, there's different retirement plans, and before I go there, there's also opportunity zones. So one of the things a couple years back was electric cars. So if you bought an electric car, you would get credit for that. If you got like solar panels, you would get credit for that. If you hired employees from the unemployment office, right? People that are going there and you hired them, you would get a credit. If you hire people with disabilities, you would get a credit. And there's a couple other things that, depending on your profession, you could get a credit for. So those are the things that I would have personally try to look into at the beginning of the year, and this coming year that's coming up. That's something that would be something to consider moving forward, right? So that's that. And then lastly would be your investments. What kind of investments do you have, and what kind of income do you have? So there's different kinds of income that I've covered before in other videos. And most people have payroll income, so that's income that's taxed at the highest tax rate. There's also investment income that's taxed at a different rate. and there's self-employment income, which is a different tax rate. So you want to see what tax rate you are and how you can move from one type of income to the other income with the lower tax rate. And if you're still making too much money, then there's retirement accounts and self-employment IRAs that you can use for you to get that even lower. So if we look at here the tax form, right? We look at this tax form here, right? Then here at the bottom there's a section called adjusted gross income, and most people confuse themselves with getting money back. Like, say you get $5,000 back, most of that money is money from your payroll that you actually already paid into it. So they probably already took out $5,000 from your check and you didn't even know, right? So that's one of the things. The money that you actually get back is, say you have kids, you have dependents, and you get some money for that. If you have, you get a credit for it. That's pretty much most of the money that you're gonna get back. Besides having kids, there's very few line items that you're available to get money, cash from it. You do get credits though. So if we look at adjusted gross income, we have, if you're a teacher, educator expenses, so teacher expenses. If you're an artist, you get certain expenses from an artist back. Here we have a health savings account deduction, so you have a health savings HSA account, right? So you could put some money into that, and that is a credit to your income. Moving expenses, if you moved from one place to another because of your job, then that would be a credit that you're able to get. Self-employment tax, if you're self-employed, you get credit for that. And then we have self-employment SEP, simple qualified plans. So that's a retirement plan where you can put like $20,000, maybe $50,000 into it, and that they give you a credit for. It does reduce your adjusted gross income, right? So it'd be a lot less. So if you're trying to buy a house, and I found this out because I've been trying to do this, they actually only look at adjusted gross income, and they won't add back in your retirement savings. So even though it's optional, they won't add it back in. The only thing that they will add back is their depreciation for any assets that you have. I think I covered that in another video. If I don't have it, then I'll go ahead and make a video about depreciation. And then health insurance, alimony, IRA deduction. So you have an IRA, you could also get credit for your IRA, and it reduces your tax bill. Student loan, interest deduction, tuition and fees. So some of the main things that I would consider doing here is your IRA and your 401k and your retirement plans. Those are some of the items that will reduce your tax liability and keep the money in your pocket. Obviously you can't use that money until you're 71, so it's kind of here and there. But if you're trying to buy a house, for instance, and they'll give you $10,000 for that. If you're trying to start a business, they'll help you with that. So there's different things that you can do to be able to save money on your taxes. And just depending on the situation where you're at, if you want any more ideas on how to go about doing so this year, I would start planning now, trying to figure out how much money I made, how much expenses I had before April, because now you have more time to make some changes to your tax planning and make sure you get the most out of it. Okay, so you have any questions or anything, shoot me a message, give me a call. My number's up here. Also, if you guys want to get more about business related topics, please go ahead and hit the like or hit the subscribe button, and I'll make sure to make more videos. Let me know what you're thinking about or what you're interested about, and then I'll try to find more information for you guys about that. So again, thank you so much, and you know, we'll stay active over here and see what we can do to help you out. All right, so thank you.